Hello, Mark Ostwald from ADM Investor Services International. I'd like to share a few thoughts on how the world looks ahead of the end of Q1 and in the wake of that FOMC meeting that we had this week. So the best place to start is probably with where markets are now discounting the next rate move and how that actually contrasts quite sharply with the forecast that we actually have from the Fed. So first table that we have today is the Fed rate probabilities by meeting. And despite the fact that, yes, the Fed did withdraw its previous forecast of 2 rate hikes for 2019, it still maintains a rate hike for 2020. But when one looks at the rate probabilities table, what one discovers is that the market's actually discounting a 50-50 chance of a rate cut in the first month of next year. So we shall have to see how that pans out. I think markets have probably misunderstood the Fed despite this very, very clear signaling. I don't think the Fed could be more clear in terms of its guidance. It can, thanks to its economic forecast with a slight downward revisions to GDP, a fairly neutral profile for inflation, and a slight upward revision to unemployment forecasts, basically sit on its hands and see how the world evolves. So we're probably in a situation where we need to start thinking about what we've started discounting in terms of where we are, where markets are at the moment. So the next chart that we're going to look at is the US 10-year yield. And what we see, and we've sort of come up against this interesting level of 2.5%, which is the top end of the current band of Fed funds rate target, 2.25 to 2.5. And that probably is where our floor should be for the time being. But more importantly, what it does represent, obviously, is the fact that we are back in the situation where we are being financially repressed. That's the fact of the matter. And thus, it is little surprise that we're actually still seeing this really very strong performance, both from equities and indeed credit. So the next chart, I think, is an interesting one because really, and one could map this over also with the Move Volatility Index, which is the US Treasury bond volatility, and it would show much the same picture. In fact, in Treasury volatility is now down at its record low, one would have to observe. So there is, despite the Fed's caution, no concern that we are going to be in a slightly more adverse environment despite the economic forecasts. And we are basically chasing our own tails in terms of hunting down better performing assets to make up for the fact that we can't generate decent returns in US Treasuries. Thus, we come to my final chart of this on all of the day, and I think it's instructive, and I think there is an element of caution which is advised on this. As we can see, the inverse relationship continues between the high-yield bond spread and the S&P 500, whereby if this high-yield bond spread tightens, then we get into a situation where the S&P continues to rise, but that high-yield bond spread is trending sideways, and I think that really is testament to the fact that everyone's now quite long of bonds and still underweight of equities, because that's been the asset allocation for the quarter. And one of the things which we'll probably have for going into Q4, into Q2, is the fact that people's underweight in equities will be quite significant and probably provide support.